Understand the risk of low-rated bonds. Some investors, rightly so, have started selling some stocks, and they are not excited about buying more stocks at this time. Also, we have been saying for quite a while now, we do think it is a wise move to sell some stocks that are overpriced. But unfortunately, it seems investors got used to the high returns and they have turned to low-rated, high-yield bonds, I think, to chase those rates of return. According to JP Morgan Chase, issuance of junk-rated bonds and loans hit a monthly record of $240 billion in July. In 2025, $930 billion has been raised through junk bonds and loans. Add that to the over $1 trillion in junk bonds from 2024, and you can see that the risk for investors is starting to increase. Most investors will not buy these individual junk bonds, but they have been plowing money into the high-yield mutual funds and exchange-traded funds, also known as ETFs. If you do dig a little bit deeper, you find some companies are raising money foolishly, like a company called TransDigm Group. The company issued nearly a $5 billion high-yield bond in August to pay a dividend to their shareholders. We like companies that pay dividends, but it should be from cash flow, not from borrowing money that has to be paid back. Business development companies are also back in the news, and these businesses make private loans to small and mid-sized companies. Over the 12-month period ending in June, private loan activity increased by nearly 33%. I have similar concerns with business development companies and private credit, which I believe will have a crash sometime in the future and cost investors more money than they anticipated. The current default rate on higher yield bonds is 4.7%, which is not bad, but I wouldn't say is good either. And I do worry if interest rates on the long end were to increase, which I still think is a possibility, the need for debt increases. This could slow the economy and cause some of these smaller companies that have these high yield loans to default and file bankruptcy, which means investors would lose money. While it is nice to get a 10 to 20% return on your portfolio, sometimes things are expensive and you have to be conservative. And while that may cost you some of the upside, the downside can be a lot nastier than you realize. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.